Hello, and welcome to the Center Show. I'm Jim Layden from the West Springfield Council on Aging and Senior Center. For today's segment, our topic will focus on financial longevity planning for older adults. Joining me today is David Fedor, president of Fedor Financial Group. David is a certified financial planner who specializes in helping clients to not outlive their money. He does this by creating and implementing risk reduction strategies, utilizing investments and insurance products. Thank you, David, for taking the time to join us today.
You're welcome, Jim.
So Dave, can you share your professional background and how you became involved in financial management services?
Sure. Back when I was in high school, I took an economics class that I really enjoyed. And I decided to pursue an economics and finance major at Bentley University. After Bentley, I got a job at MassMutual working there as an analyst. During my tenure there, though, I met a young woman who recruited me to join her working at John Hancock as an investment management specialist. So I worked with her for about 3 years, and I became so enamored with her that I asked her to marry me. Okay. So we're still married today.
Great.
And during my tenure at John Hancock, they made me the estate planning specialist of the office. And then at that point, I was recruited to work for a local bank as an investment specialist. So I spent 14 years at a local bank as their investment specialist in the office, and I specialized there working with seniors primarily. After about the banking crisis, when that banking crisis hit back in 2009, 2010, I re-examined what I was doing at the bank, and things had really changed. Instead of being focused on the client, the banks were more focused on the profits. So I decided that there has to be a better way, and that's why I ended up severing my relationship with the bank, and I opened up my own financial planning practice, specializing in working with seniors, called Fedor Financial Group, and we're located in West Springfield, Mass.
Okay, all right. So can you tell the audience about the services your firm offers?
Sure. What we do is we sit down with our clients and we find out what's important to them. Oftentimes it has to do with not outliving their money. So we look at longevity planning. We can create retirement plans that look at what their assets are, and it'll show how long they may last. Secondly, we look at insurance planning. We look and see if they have any insurance accounts, and we can help to make those insurance accounts either get them more bang for the buck, or we can also do long-term care insurance for them as well.
Do you offer products specifically designed for those in retirement or who may be retiring in a few years?
Yes, I touched on that a minute ago. The retirement planning that we can do, it really helps because a person can bring in all their statements. We can take a look at their income, their expenses, and find out, we can do a projection how long that money may last and what the odds are that they may run out.
Right.
We also can look at the risk level of their investments, and we can change things around a bit to try to enhance the efficiency of their portfolio. Another thing that we look at too is whether or not they have existing annuity accounts. If they have an annuity account, sometimes you can actually convert that annuity account to a long-term care qualified annuity, which if they take the interest out of that and use that to pay for long-term care expenses, that money will come out tax-free based on the Pension Protection Act of 2010. Finally, we look at their life insurance. And if they do have a life insurance policy, we might be able to convert that to a long-term care life insurance hybrid policy. So it does both, and it will protect not only their loved ones from a premature death, but it also could protect from a long-term care event as well.
Okay. So we know that people on average are living longer, which requires the need for additional health care services. With these rising costs, is long-term care planning a worthwhile option and investment?
Oh, absolutely. The biggest problem that I've seen is people running out of money during their retirement because they haven't had the proper planning done early enough. The worst thing is if you have a healthy spouse who's staying at home and they're caring for their loved one, and the loved one requires long-term care, if that loved one uses up all their money, all their resources, the healthy stay-at-home spouse may end up having to sell the home and move somewhere where they didn't want to before.
Okay. You've mentioned the term long-term care, but what does that specifically mean? I think a lot of people maybe associate that term with just a nursing home, but it goes a little bit further than that, doesn't it?
Absolutely. Long-term care is a chronic illness that lasts longer than 3 months. When I think of long-term care, typically you think of Alzheimer's, dementia, arthritis can be one. It's something that lasts for a long period of time, and it's not going to get better. Usually it's just an illness that you manage.
Okay. Can you give some examples of current costs older adults are facing when it comes to nursing homes, assisted livings, and home health care?
Oh, absolutely. If you look at the cost of a nursing home around here, we're looking at around $10,000 a month. It's over $100,000 a year. The cost for an assisted living facility, which many of them are very nice, and those appear to be the preferred method now that people use instead of going to a nursing home, those are still going to run you about $4,800 to $5,000 per month. And finally, if you look at the cost of a home health care agency to come in, which we had for my mother for a little while, that costs about $25 per month. I mean, $25 per hour. $25 per hour. So it depends on the level of care that's required.
Sure. But then you can see why people can run out of their money with those types of costs.
Exactly.
Yeah. So can you explain how long-term care policies have changed over the years?
Well, yes. In the beginning, long-term care policies generally would pay, you'd have to pay the premiums indefinitely. That meant that as long as you were healthy and not on claim, you would have to keep paying and paying and paying. And what would happen with those policies, though, they're fairly expensive. They're thousands of dollars per year. So many people didn't want to take the chance on buying a policy in the event that they didn't actually use it for their own benefit. So they, only about 1 in 10 seniors actually owns a long-term care policy like that. The second type of long-term care policy, which is a newer innovation today, is a hybrid long-term care / life insurance policy, so it does both.
Okay.
Many people prefer that type because either way, they know that they're going to get some return on their investment. A third type of long-term care coverage is a long-term care annuity. And if that is an account that if they have an existing annuity, they can take the money in that, and as long as they're medically qualified, they can convert it to a long-term care qualified annuity. So it still would be tax deferred until they take it out, at which time all the interest that comes out, so long as it's used for long-term care qualified expenses, all that interest becomes tax-free.
Okay. So if you had one of the traditional long-term care policies, you can convert those. You can get out of something that maybe you had prior to get into something that's more modern that meets their needs?
You could. Okay. You could convert. You'd have to reapply and you'd have to be medically qualified, but you absolutely could take a look at that and apply for either a long-term care qualified annuity, a hybrid long-term care policy. And even today, some people do still like the traditional long-term care insurance, and you can actually put a rider on that, which has a return of premium, so at least you won't be out your initial investment on that too. So that is another innovation.
Sure. So can you discuss the application process?
It can be lengthy. When we first have a client come in to see us, what we like to do is sit down with them and pre-qualify them. We have a form that we can utilize. We ask them a bunch of medical questions, and then we'll send that out to various insurers to see whether or not they'll insure the person, and if they will, what do they think the offer is going to be for that client applying. So it really helps doing that, because the worst thing that happens is if you apply for insurance and you get declined, then nobody wants to take you. So pre-qualifying is very important first, and then we'll send it out for the pre-approval, and then we'll take an application. We send it up to whichever insurance company gives them the best offer. See, as an independent firm, it doesn't matter to me which company that we use, so long as my client gets the best offer from the insurer. Okay. So we'll forward that on, and typically it's going to take about a month or so to actually get approved. You also may require, the insurance company may require you to go for a physical, or
yeah, I was just going to ask you, does the potential client have to meet with a physician to be medically cleared and kind of get a history of their health?
Usually they'll send out a paramedic to your house.
Okay.
Yeah.
Okay. So How does an older adult know which policy is right for them?
Great question. What I would advise is you sit down with somebody who's qualified, either a certified financial planner who specializes in working with seniors, or somebody like that that can, they should be independent also, and take you through the steps of that.
Okay. You mentioned the hybrid policies before. Can you just go a little bit further into detail, because that seems like a popular option nowadays?
Yeah, they're a lot more popular now because you don't pay on something and then potentially lose it. There is something there that would be paid out in the event of either the client's death or paid out in the event of a long-term care event. So hybrid policies, often when they initially issue the policy, the death benefit on them is about 2 times what you put in. So if you put in $100,000 into a policy like this, let's say somebody has, or let's say you have $100,000 sitting in the bank and you're 65 years old and you want to protect yourself. And I say, Jim, why do you have the $100,000 sitting in the bank?
Okay.
And you say, well, it's my just in case I get sick money, Dave. I would say to you, well, let's leverage that up, put it into a hybrid policy. In a hybrid policy, I have seen them leveraging it up to 2 times what you put in as far as the death benefits, so that's worth about $200,000, tax-free upon your death, and almost approximately $300,000 would be the value for a long-term care event. So they also would be able to pay anywhere from 2 to 3 years is the average long-term care payout on something like that.
Oh, okay.
So it really leverages up the money.
Sure. Do you find people are reluctant to let go of that nest egg to invest in these long-term options?
I wouldn't advise it unless they have other assets, other resources as well.
Okay.
Yeah, it's a large investment. It's only for the people that they already have the money and they're looking for a better place than the bank. The bank is maybe paying them 0.1% or something like that. So they're really not making anything anyway, and it would take years and years and years for the value of that bank account to increase to the value that it would become automatically if you're approved for the insurance.
Right. Okay. So how are the premiums determined, Dave?
Okay. What happens is they look at the age of the insured and the health of the insured, and then the amount of insurance that they're applying for. So obviously the older that someone is, or the less, the not so good their health is, it's going to cost more in terms of how much you have to put in, and you're going to get a lower a benefit on the policy. Oh, and the other thing is the length of time or the benefit period that you select. If you get a policy with a longer benefit period or payout period, then that's going to cost you more as well.
Okay. So do these premiums increase annually?
Yes and no. The short answer is no, they don't increase annually, but they actually can increase on your standard run-of-the-mill long-term care policy. They typically will only do that for a whole class of insureds, so somebody like all the same age or the same type of health. And they don't do it that often, but when they do it, they can go up like 25% on the policy premium. So when you first get a policy, you can imagine at 65 and then say you're 75 or 80 and the insurance company raises your premiums by 25 or 30% and your income or your assets haven't kept pace with the cost of inflation, you might end up having to lapse or let go of the policy.
Okay.
So another reason why many people prefer the hybrid policy, because typically when you put the money in, you're done. It doesn't usually reevaluate and say, okay, you need more money.
Okay. Okay. So are there age limits on certain policies?
You know when the best time is to get a long-term care policy? It's when you're still healthy. Okay. You have to apply for it when you're still healthy. Now that being said, to answer your question, a lot of companies actually cap it at 80 years old.
Okay.
But oftentimes I see this when people come in to see me, and because I specialize mostly in working with seniors or retirees, a great time to look at it is when you are either contemplating retiring or you just retired, and if your health is still decent, that's a great time to look at getting long-term care
What's the
insurance.
youngest you've ever seen somebody get a policy?
Probably 60.
How long are long-term care benefits good for?
The average length of time that a long-term care policy will pay out is about 2 years to 3 years. So I often see the benefits of 30 months.
Okay. So you mentioned being medically cleared. How does someone's health factored into these long-term care policies? Because there's so many different types of levels in care of people's health.
Okay. I've gotten people coverage who have had prostate cancer. The health can be tricky because it depends on what it is. If it's an activity of daily living, one of those ADLs they call them in the insurance world, eating, dressing, bathing, toileting, moving from bed to chair, that, if you have a problem with that now, you're probably not going to get the coverage. I can give you an example of one of my clients who has had difficulty walking. He had a back problem, and the nerves weren't, his spine was squeezing the nerves down to his legs, so he wasn't able to feel the bottom of his feet, and he was having difficulty walking. So when we initially applied for insurance for him, they actually declined him, and they wouldn't take him, but they did say to reapply in 6 months after he had his surgery. So we did that, and he was actually approved after that. So a decline is not necessarily a no forever. You have to keep that in mind. You can always try to reapply again if your health has improved.
So can couples purchase long-term care insurance, Dave, or does it have to be done individually?
My recommendation there is if you have a husband and wife, if you're married and you both think that you're interested in it, you should both apply, because there are couples discounts often through the insurance companies that can help save a lot of money over time. You'll get more bang for the buck that way. Of course, it depends on health, and I have another couple of folks that are coming in to see me this Friday, and the husband has diabetes. The wife's health is pretty good. She has high blood pressure, but otherwise, you know, many people who are older do. So we actually have to go to 2 different companies for that, because the company that will accept her will give her a much better rating than the company that would accept him. So what I'm saying is, as an independent again, I'm able to go to different companies, and it doesn't matter to me so long as my client gets the best coverage. If I were to put both of them with her company, well, her company wouldn't even accept him. And if I put both of them with his company, she wouldn't get as good of a rate. So we can mix and match.
Okay. So what happens if someone purchases a long-term care policy, but they never need to use the insurance?
Okay. Well, the old way, a typical long-term care policy, which you paid on, you may end up passing away and you end up forfeiting whatever you put in. Now, they do have a rider available on the newer policies, which would enable a return of premium back to you in the event that you passed away prematurely and you never collected on your long-term care insurance. That's the standard long-term care policy. The newer versions, the hybrid policies, those, as I mentioned earlier, would have a tax-free death benefit that would be paid out to you as or not to you, but your beneficiaries, which would be typically much higher than what you started with. So you wouldn't lose it. It's why a lot of people like it. Oh, and the other thing with the hybrid policies is that most of them will allow you to completely close the account if you change your mind after 2 years with no penalty, other than a loss of your interest that you might have earned.
You mentioned the death benefit for beneficiaries. Does it have to be a family member?
No, it can be anyone or any organization that the person feels strongly about. And it doesn't go into probate.
All right. So what are some of the issues you have seen when people go it alone on long-term care expenses?
Ooh. Well, the typical response, nobody wants to talk about it or think about it. And I often see people that don't take any action at all. In fact, I have a great example of that. When I first became licensed about 20-something years ago, I went to my father and I said, "Dad, I think you should buy long-term care insurance." And he said to me, "Dave, don't worry about it. I've got that taken care of." So fast forward 20 years later, it's now 2015, last year, and my mom got vascular dementia, and she was having many strokes and a lot of health issues, which caused a lot of problems in the family. So Dad's his solution was, his thought process was that he thought he was going to be the one to pass away first.
Okay.
And that's why he didn't get the insurance. So I found that out later at her, after we buried her. I said, "Dad, why didn't you ever get the insurance?" And he goes, "David, I thought that I was going to die first."
Okay.
And then it all made sense to me that he
Right.
just figured that Mom would be taking care of him.
Right.
So you never know.
Right. No, you're right.
Yeah.
Does Medicare or the Affordable Care Act provide long-term care benefits?
Ooh, unfortunately not. Now, that being said, Medicare will pay for some care in a nursing home as long as you meet certain requirements.
Mhm.
But they'll only pay for a limited amount the first 20 days and a smaller amount the next 80 days, and then they pay nothing after that. The Affordable Care Act doesn't cover it, but what you find is that the only way that you can get government assistance for long-term care in a nursing home is if you are impoverished. And basically you can only have $2,000 in your name if you're an individual looking for government assistance.
Okay. So what are some other areas that older adults should focus on when longevity planning?
Oh, I would look at, first and foremost, budgeting and making sure that your money is going to last. Because without that, everything else goes kaput. So we will encourage people to look at what you have invested, how is it invested, is it all in one thing? For example, I had a client come in to see me, and she had inherited a bunch of money. It was all in utility stocks, primarily gas and oil. And remember, gas and oil just dropped 50% last year. So her stock portfolio went down the same amount, and it was terrible to see. So you really have to look at the client's portfolio and see how much income it'll generate and how risky it is. That's number one. And secondly, you also want to look at beneficiaries. This is a big one that not many people think about. If someone passes away and they haven't updated their beneficiaries on their accounts, oftentimes you see this in divorced families, 50% of people were divorced, then you may end up leaving that money to your ex-spouse who is going to have a real fun time with that. So you have to check your beneficiaries. Number three, you want to enlist the services of a elder law attorney. Again, I'm always talking about somebody who specializes in working with seniors. One of the things that came up again in my own family was we couldn't find my mom's health care proxy. So we knew who she wanted it to be, but we couldn't prove it. And finally we did find it, but in the initial stages of her illness, it was a little challenging there. So you do want to have all that paperwork in place ahead of time.
Sure. Okay. So how does someone schedule an appointment to discuss their financial strategy with you, Dave?
The best thing I'd say is to call. Call us at 413-726-9044 and schedule an appointment.
Okay. And do you have a website?
We do. It's fedorfinancial.com.
Okay. It was a great interview, Dave.
Thanks.
Appreciate all of your information. It was a pleasure having you on the Center Show today. Thank you again.
You're welcome.
Well, that concludes this segment of the Center Show. I want to thank David Fedor for taking the time to share some valuable financial service information. Stay tuned for next month as we learn about local, all-inclusive PACE programs for older adults. The West Springfield Council on Aging and Senior Center thanks the viewing public for this opportunity to serve you.